On today's episode, I have Tyler Hague, multifamily investment sales broker from Colliers. So he's been on the podcast before. He's one of my favorite guests. And what we're going to do today is go through what's going on in the multifamily market in August 2023. And Tyler covers over a dozen markets, so it'll be an interesting conversation hearing about more than just one place. Enjoy.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint.
All right, welcome back to another episode of the Breneman Blueprint. Tyler Hague's on the podcast, multifamily investment sales broker.
Thanks for having me back.
Awesome, yeah. So yeah, just before we started recording, I was telling Tyler the podcast has really grown a lot just in the last, especially 6 months. I've went on over 30 podcasts like in the last year or so, or really in the last 6 to 9 months. So that's gotten a lot more traffic on this. I just kind of been putting out episodes weekly. So that's helped kind of people look for it. And then obviously, having interesting things to say. I mean, the last episode we had I really liked because, I mean, it was more like, hey, here's what's really going on. Not sort of just everyone saying like, hey, it's all rosy and it's all good. Like there's trouble out there. It's not everybody's in trouble, but there's, a lot going on where it's not like 2021, whereas everything's just a 3 cap and, 50 offers on it. So, anyways, so yeah, just, if you could, make sure to tell a friend about the podcast that would enjoy it. If you can leave a review on either Apple or Spotify, like a 5-star review, obviously, that will help, where I'm over 100 reviews now on Apple. So when people look at the podcast, they see it's a good podcast and has like a big audience. So that helps, and also helps like if you were just type in real estate or Colliers or some keyword, like come up, closer to the top because it has a lot of reviews. So anything you can do, I'd appreciate. Anyways, Tyler, why don't, if people haven't heard your story, maybe just give like a brief overview, who you are, what you do.
Yeah, absolutely. And thanks for having me back again. I'm a executive vice president with Colliers. I run our Midwestern apartment practice out of Chicago. I'm in about 15 states in the Midwest, from Oklahoma to Ohio, Arkansas to Minnesota. And then I've got a business partner who operates in the Southeast and the Mid-Atlantic, and then runs our national business as well.
Awesome.
And we've done a little over $3 billion in sales over the last, call it 15, 16 months.
Nice. Yeah, that's big volume. It was all like...
It's not growing anymore.
Yeah, I was going to say, that was all 12 months ago?
Yeah, no, you know what? It's been a tough year. People keep talking about are we going to have a hard or soft landing? Are we going to be in a recession or not? And I've been joking with my team that the multifamily recession's been going on for the last six to 8 months. But we've probably got... We've been on a hot streak lately. I put a deal under contract this morning, which is exciting. A nice value add deal, very contentious negotiation. But we've probably done, $300 million in sales this year, which is, 10 years ago, you and I talking, it would have been like the greatest thing ever. It's just with the market and the change in the last year and a half. I mean, it's been night and day different. And everything's tough right now.
Yeah, it is. And I think, that's still a lot of volume. I mean, just the markets we cover.
We feel really good about it. But, with all the movement in the rate environment and SBF and, there's a lot of nervous equity out there. And that's really been the biggest change that we've seen. As it was, a year ago, or 2 years ago, you could throw any deal out there and probably get a lot of subscribers to provide equity. And I'll give an example of this later, but all the institutions are gone. All of our deals right now, there's practically no institutional equity available whatsoever.
I've heard that.
Yeah.
Because I just spoke to someone who was like, yeah, above $5 million, the market's still really strong. And I was like, well, yes, but once you get to about 40 million, it just really starts dropping off, because all those family offices, private equity funds, whatnot, they're looking at real estate equity going, I don't think this isn't, return's not very great right now for the risk. I mean, sadly, you can make 12, 13, 14% doing pref equity. Why take on the common equity risk?
Yeah.
If you're a family office where I'm investing in everything, I got my tech investments, I got stock market, I'm in debt funds, I'm in equity, I'm in I'm private real estate, hedge funds, private equity, and then you just go, yeah, this makes a pro forma 15% IRR, but I can just do debt and make 12.
All that institutional equity wants to be on the credit side of the business right now, doing debt, or if it is equity, it's pref equity. I had a call this morning with a large national developer who's got a couple great sites they're trying to capitalize, and they need a $20-30 million check, and don't really want to go out and raise it $1 million at a time. So there are a handful of groups out there that are still providing equity in larger chunks, but a great example on the buy side would be, we just launched a deal in Greensboro, North Carolina, about 45 days ago. Had about as much action on that as we've had in anything over the last couple of years. We got 46 offers on this deal.
Nice.
And we did not have one single institutional equity group bid on it. They were all family offices, all private capital, and half the buyer pool I've never heard of before. And so that's been a little bit of an interesting change in our business, is when as a broker, we have to try to mitigate our risks of our clients in these transactions and vet through buyers. And, sometimes people emerge who might be the buyer, but you have no idea who they are, what their track record is. And so it's actually been kind of fun to figure that out and vet through that a little bit. But it's been a challenge, and you have to stick your neck out as a broker when you make a recommendation to go with someone.
What size is this deal? Like in dollars, the Greensboro?
It was, I think it was a $35 million deal. It's going to go for like $6 million over ask, which is crazy. But it was priced right, and as we move into this conversation, we're going to have we have a lot of listings we're about to launch, and we've been having a lot of tough conversations with a lot of sellers. And the smart money and the smart sellers are pricing their deals right, kind of letting the masses come to them and letting them bid it up at the end, where there's a lot of sellers that have a debt or a certain math equation they have to solve to get their returns to exit these deals, and a lot of them don't realize that they're not going to get those returns, and they should probably sell it now and not wait 6 to 12 months, because I don't think the market's going to be better in 6 to 12 months personally. I'm kind of curious what your take is on that. Whether, if you had a, gun to your head, you're obviously going to have to force a decision. But, if you have a little flexibility, we've been kind of surprised that some people have been selling right now.
Yeah, well, it's tough to take the L, as they say, I guess. But if the options were, I think if you're selling a year from now or right now, basically I think the prices will be essentially the same. So you're underwriting, or you're looking at what are your returns? Well, if you're going to sell it for the same price a year from now, obviously your returns are lower if you wait a year. So I would just sell now. And I don't really see what would make the prices be meaningfully higher. So if anything, there's more risk to the downside. In the next year, in a 3-year window, I can see somewhere around year 2, I think things are going to turn around. Where
I agree with that.
where we have developments dropping off a cliff, to your point, where no one can get their deals capitalized, and then the ones that could, they look at, oh, this is how much more my interest costs are now. Now my deal doesn't pencil, and then the deals aren't happening. So then there's going to be a supply drop off, and in these markets where there's still a demand tidal wave, like where I'm looking, Phoenix and Dallas and Austin, and these places, there's a lot of building right now, but I don't think there's really much could be behind that. So they need to work through the near-term supply, but they still have a lot of people moving there. And so I think, like 3 years from now, I think it could actually look pretty good, where you're going to have really good supply-demand scenario where rents could be running, in terms of the increases, running up a lot. And then you have, and interest rates will be coming down. What does it look like exactly? I don't know. If I had to guess, I'd say rates are in the fours, let's say 4.5 to high 4s. Probably, if I had to be more specific, 4.5. Because I think like in 2018, the Fed was raising rates, and rates got into the low 5s for smaller loans, right around 5 for bigger loans. And then, when things were in the 3%, it felt kind of artificial almost, right? Like we're doing all these things to get rates low, and sort of seems like the natural, like new normal for rates is like kind of 4s, 5-ish kind of thing. I'm talking about right now, first mortgage, stabilized like a Fannie Freddie loan. I'm not talking about debt funds or like a normal bank loan on a stabilized deal, I'd say. But I'm not talking about CMBS rates or some of these other things that are a little different. Life insurance companies, life co-loans probably would be a little bit lower than that because they're lending lower loan to values on newer, nicer stuff. So obviously they should be cheaper.
I would definitely agree with that. The main impetus for my opinion, I guess, is, last time I came on here, I gave my, bold prediction. I think there's going to be some problems in the apartment space, and I still do think that. And we've actually started to see some REO come through by the way of listings. And so, and it's the same story over and over with, bridge debt, effectively, putting these borrowers into a position where they don't have an out. And, I think the challenge I have in making recommendations with clients right now is I think there's, you don't ever want to be the seller in a market where there's a negative snowball effect of values being, think about Chicago right now. So I've got a high rise on the market in the Gold Coast. We are, close to an actionable number. The price of this deal is kind of crazy. It's $50 a door under what I would expect it to be.
$50,000.
Yes, $50,000 a unit under, and it's a 160 unit property.
And why is that?
Well, the Seneca just traded for a similar discount, about 20 or 28% discount from the last purchase.
Yeah, I saw the article. I saw the headline, huge loss, basically.
Huge loss. There's been a number of similar headlines, whether, the Class A product that's been, sold at a loss in this market has been funds forced selling assets to either close out their fund and book returns and they don't care, or effectively harvest some losses as well and free up cash to go redeploy in, a year or two. And so, what you don't want to do is be, pigs get fat, hogs get slaughtered, and people who are clinging on to this hope that, we're magically going to get back to the environment that we were in. Chicago real estate has just started to get sold at the basis to which the capital is willing to pay for it. It's a market correction. I actually think the Chicago market's more stable than a lot of other places in the country. I think I said that before because, you didn't have 2.5 caps or 3.5 caps in Chicago for the last 5 years.
And you have a lot of long-term owners, a lot of fixed-rate borrowers, and the average hold period for properties, if I had to guess, it's probably triple the length it would be in Florida or Texas or Arizona, where, people own property for like 2 years there.
Yeah.
And here it's like a lot of 10-year deals or people's business plans, and some people just owning stuff like for generations. So,
and the rent growth, I'm curious kind of what's going on in this building. that you obviously own. I mean, the rent growth that we're seeing has been pretty substantial. The fundamentals are really good. And, at the end of the day, there aren't a lot of cities that can be replicated like this. And so, where I'm more wary in my business is, Kansas City or St. Louis or Kentucky or there's a lot of places where people got a little over their skis in 2021 and paid, 150 basis point cap rate lower than they should have because it was a competitive situation. They put 3-year Freddie floating bridge debt on it. Their rate cap expired. Their IO ran out, and now they're going into a market where I talked to someone from, it's funny that I'm even going to say my competitor at Northmark, and who runs their group, and he thinks treasuries are going to 5%, and so if this environment stays elevated through 2025, you've got a lot of maturities coming. There's a lot of maturities next year, and once these guys have to liquidate, they're going to do it quickly. And so if you go to take a property, if you wait 6 months or 8 months and that happens, you're going to probably sell for a larger loss then than you would selling it right now.
Yeah, that's interesting. Yeah, and I think too, the people that are really poised to get hurt, like those markets that aren't the ones that are just like booming from like a rent growth and like on the demand side. But yeah, these deals were selling for 3.5, 4 caps in markets that had no business being that. At least like with Phoenix, like people would look at that and you go, okay, my taxes don't adjust on sale and I can raise my rents 20% to this. That's what the market rent is right now. Not I need the market to improve. So you do that and you're at a 5 cap in like 2 seconds. So like even the deals that we bought, like we're all stabilized north of a 5 cap, and all but one has fixed rate debt in the 3s. And actually one of them's at 4.25. So like all those are actually cash flow positive. Obviously, if like we bought them before prices adjusted. So like our business plan is to ride out the loan term we have. We have 5-year fixed, so and a 7-year fixed on one. So we're just going to ride it out, and it'd be a lot different in 5 or 6 years. So those, anyways, we insulated ourselves because they were value add deals. And we had loan term, but imagine you did neither of those things. You bought a stabilized 4 cap, 3-year term, and a floating rate.
You're in a lot of trouble.
2-year interest rate cap, interest rates raised. Snap your fingers. Cap rates in Kansas City 5, 6. What is it now?
Yep. And great segue into there was an article this week in the Real Deal, and we I knew that a lot of this was coming, and there's some larger other names that weren't mentioned, but. The article effectively was talking about how some of these large national syndicators went from, $500 million in assets to $7 billion in assets in like 2 years. They bought all this product, and exactly, what we're saying is happening. 20 to 30% of their portfolio now is in dire straits. They're trying to do capital calls. They're handing the keys back on deals, and everybody knows that there's blood in the water. And so, I just think to myself, logically, if that's happening to those 7 groups, which, I won't name them on this, there's a lot of other people out there that have a lot of problems too. And on the ground, I've turned into a problem solver. My business partner's turned into a problem solver. And we have clients that are, need to, free up cash very quickly. And deals that were supposed to be sold in 2 or 3 years are being sold now to do that. And so, and those are the smart people getting in front of this. And not, sitting back like, oh, hey, broker, why would I ever sell this for a 6 cap today? This is like a 4.9 or a 5 cap all day. And so we're still having trouble with sellers moving down to the market, and so it's all I can do is, give my honest opinion to someone and make them a recommendation. And it's kind of like you can lead a horse to water, but you can't make them drink. So
yeah, and I think too in that article, I know which one you're talking about in the Real Deal. I thought I read most of it. I thought only 4 groups were referenced.
There were 7.
Okay, there were 4 in the picture, and I remember reading it and going like, I mean, some of this is a little bit speculation where there was a announcement like one of them's doing capital calls, but like that's not a surprise. You're all in at your interest rate is with your interest rate cap, it's in the 6s or 7s, depending on when you did this. You're stabilizing these deals at 5 caps. Of course, you need to add money.
Yeah.
The thing is, at least the ones that were in the photo, they do value add deals. So I remember reading it like, well, like we'll see, if they can keep them till things normalize, at least they stabilize at respectable cap rates. The people that are in just the most trouble are the ones where there was no value add.
Yeah.
I guess I don't want to say because I never bought any of this. They just bought a deal that made 4% unlevered, so a 4 cap, no upside. The market shifts to a 6. Okay, quick math, your value is down 2/3, right? Or sorry, down 1/3 at 4 to a 6. And then now also interest rates are way up, so you're sizing to a way lower loan. Maybe they finance at 75% loan to cost. Like now they need to add a ton of money. It's not even worth the debt if you did it 75% loan to cost because it dropped 1/3. Like that's a tough predicament.
Well, have you and I are the same age. We've been doing this for about the same amount of time. I mean, when have you heard of people writing checks at closing tables for refinances? I mean, we've been seeing that a lot where, you have a client trying to make a decision, and the decision, they're like, oh, we got these debt options, we're going to go this route. And then they come back to you and they're like, yeah, those debt options didn't work. We had to put, we had to write a check, $2 million check just to refinance our deal. So we want to sell it now. We're having a capital markets problem. It's not a fundamentals. Sure. Are there some people out there that took a little too much risk, got a little too aggressive, grew too fast, and maybe should have slowed down, but the equity was pouring in and they were being pushed to do more deals? And you and I probably would have done a similar thing, maybe a little more, carefully. But it's a capital markets problem. If the Fed doesn't raise interest rates in the aggressive manner that they did, I don't think that we'd be having this same conversation. And I think that the market bails a lot of those guys out. But that's not what happened. And unless the Fed or these banks start to make some meaningful changes in their policies, I'm seeing them move to liquidate and not try to kick the can down the road, because the banks are scared that, just like the equity right now is afraid to deploy into new deals. Go talk to any lender out there right now. Even if you have a really great property in the best location in Austin, there's still a little bit of hesitancy. I mean, maybe that's a
You're
bad
talking
example.
about banks.
I'm talking about just the lending environment right now.
Because they're not getting the loan payoffs they used to, so they're not like recycling the same loan dollars, and they're going, okay, so we're going to increase our book of loans at a time where we're worried about being the next Silicon Valley bank where people are going to yank deposits. Like, why would we make this loan that's not worth the risk right now? Almost at any interest rate, we need to just hold on to our deposits.
Correct.
If anything, start having the bankers call, seeing people want to make deposits.
Yeah, I mean, I'm gonna, the dirty little secret that I'd be curious if you're feeling the same thing. I mean, we are either entering or already in a credit lockout in the market. That's already it's been happening since April, quite honestly, and it's been getting slowly and progressively worse. Thank God for the agencies and for HUD. But like, a problem I have right now, which is a weird problem, is if I encounter a value add deal, even if it's a value add deal that I really want to sell and I've been chasing for a long time, it's really hard to get those deals done, because if your seller wants if you have to pay a low going in cap rate and you're going to get to a 6 in a year or two, it shakes out to usually your LTVs in the 50s. Like you're going to do a 55 to 60% deal if it's not 95% stabilized and fitting into that agency box. And so for us doing BOVs and pricing deals, it's actually made this a lot more difficult than it was before.
For sure. Yeah. And before we started recording, you had asked, how do you even finance a value add multifamily deal today? And I started answering. I was like, actually, let's just
questions a broker should never ask.
Oh no. Well, it's
no,
just kind of like, what's our strategy? What's our strategy in case there's anything like new he can share, but it's I doubt it's a new, but like really the best execution we see is you're doing a Fannie conventional 5-year fixed, and you're renovating out of cash, out of equity you've raised, to be more specific. So to your point, what does that look like in the markets we are tracking? The Phoenixes, the Austins, the Dallases. It's, give or take, you're putting 45% down, 40% on the purchase, then renovation out of equity raised and cash flow. But there's no cash flow while you're renovating. So really just out of what you've raised. So, for a round number, it's 50% debt, 50% equity. So what does that mean? To get it to size out respectably, like you need to be at roughly a 5% cap rate going in day one on a value add deal. Because then you're going to put this mid to high 5% agency loan in it. So you need to be pretty close to the debt rate. And then depends on the market. I mean, Phoenix right now, feedback we got was assume the day one cap rate's equivalent to the interest rate on a value add deal on the agency. So let's say 5.5 in Phoenix. In Dallas, they'd say going in 5 cap day one on like 80s construction value add. Let's say if it's really old or needs like a deeper value add, it's a lot. It's higher. And then if it's like a 2000s deal, that's could be lower in terms of the cap rate. Anyways, and then Austin, there's a lot less activity. So that's that we're still figuring out. But it's inside of Dallas. Like it's too much jargon. The cap rates are lower than Dallas, obviously, and Austin, for a million reasons. And usually, what's been going on is about 50 basis points lower, is what we were told, and what we've saw as well. So, what does that all mean? It's everyone's got more or less the same strategy on financing it. It's more or less just who needs to buy, if you will. And so, what we've saw so far is we haven't really saw that blood in the streets type pricing. Like we've saw distressed deals sell. We bid on one in Dallas. We bid on one in Tempe, Arizona, for example, recently. The Tempe one, I think,
like
had
a bank distressed deal.
Owner. The Tempe one, the guy, it's just a guy essentially that owns it. He's got a dozen or so deals, and they're all in the scenario we're talking about. Bought it at a 3 cap, stabilized it at a 5. So he's not losing money per se, but he can't refi because interest rates are pushing 6% now, and he'd have to add too much money. And he owns a dozen deals. So who has the money to add $2 million to every deal and pay your loan down? He doesn't, or at least this one he wants to sell because of that. He'd rather sell than add. So technically, I guess that is distress. Like he needs to sell it. The problem is,
I'd call that a seller under duress.
Okay. So he's under duress. But the problem, if you will, for like as a buyer is I am underwriting barely any market rent growth. I'm underwriting these higher interest rates. I'm not assuming cap rates go down in my like underwriting. I'm assuming they stay the same or go up a little. Because that's like underwriting red flag one is like trending your cap rate down. So we don't do that. But then the problem is transaction volume's down 80% in Phoenix. So this thing gets like a dozen offers.
Yeah, it gets mauled.
Yeah, and it doesn't, and it goes multiple rounds, and it gets bid to a price where we look at it, and it's on our underwriting, the levered IRR, and it was 8%. And you're doing value add risk, in a volatile market.
By the way, I have to interrupt for a second. So I have a deal that is operationally challenged that we underwrote recently, and my analyst and I were like trying to figure this out, and we're like, how how are we going to put debt on this? Our debt guys, didn't really like it. And you had to put I think it was like a 50%, cash in kind of deal. And we decided to underwrite to unlevered returns. And to get to where we needed to be, because there are balance sheet buyers in the market. I like your response with the value add, because that's what everybody we're doing value add deals with is doing. And the fact of the matter is, most people understand that in 2 years or 3 years after you do that, and if you hit it at the right time, you're going to do really well on that refi and on the back end of it. And so it's just we're just in such a weird place in the market. And the sad thing about all of this is it's kind of artificial. It's been artificially created by the U.S. government. So,
yeah, I mean, your average person on Main Street and your average voter, though, they don't own any multifamily deals. And it's impacted us, heavily, because we're on the tip of the spear in this capital intensive business where you're borrowing money. And so for us, it's been painful. But for, people on Main Street, what's been painful is, inflation.
Yeah.
So
well, they do keep calling, I keep reading and hearing the word, recession is what's happening. And that, effectively, for a lot of people who are, middle income or below earners, things are going fine. They probably refied their house. They probably have a couple $1,000s extra in their pocket every month. And it's the people who own assets and have, invested in things in, a artificial market for, I guess there's no other way to put it. It was an artificial market. Rates should have never been at zero. And at some point, those asset prices have to get unwound to a certain degree. And that's really what I see is happening is, the smart put fixed rate debt on it, on their properties. They're sitting back and pretty happy that they did that. They don't have any real pressures. And they're waiting for the time to strike and jump back into the market. And the biggest challenge that we're seeing overall outside of the debt is expenses. Expenses have been increasing across the board pretty dramatically. And people still haven't totally changed their underwriting standards on, what your expense situation is, especially insurance. We talked about insurance a little bit last time. Even in Chicago, or anywhere in a place where you wouldn't expect your insurance costs to go up, they're going up 25%. And
yeah, ours went up in the Midwest stuff we got, and then with the Phoenix stuff, ours went up 12%.
Yeah, I've heard Texas is really bad.
Yeah, it is. I mean, and they have a lot of hail, and other things, flooding, depending where you are. I mean, Houston is, along with Florida, is barely insurable at this point.
Yeah.
But yeah, that's been where, even in those markets where there's not a lot of losses, what happens in Arizona, nothing for that. But
no water.
It's still the cities that are there are fine with their water.
Yeah.
I can send you stuff if you ever need it.
I know.
It's these outlying places where they're trying to pull groundwater that they don't have more of or something. But they don't. But so we have let's call safe properties. We're not in California where there's earthquakes, or Florida where there's hurricanes, and we're up 12. Mm-hmm. I mean, these places where I think you had something with the Florida deal where it was went up from 500 to 2,000 a door or something.
I mean, I just it's not my client, it's my partner's client and my partner's deal, but we were actually just talking about that deal. We're about to get the listing on it. It's a very large transaction. I think the rent growth on it is they're up 70%, and they are going to effectively sell this for a break even because their insurance costs have quadrupled. Their labor costs are up. They've just had expense creep everywhere. And even though they've done everything that they, put out in their thesis to to execute this business plan for this property, there's been other forces that have, crept into their returns. And, again, it's like that real deal story. I think it's funny to me to a certain degree because I'm out in the market. We're pretty active still. Like we probably have 25 listings that we're launching in July, which is a lot for right now. When, a lot of the rest of the market has been so busy. And so, there's a lot more, I just think there's a lot more problems out there with a lot more groups, and nobody wants to talk about it. And no one's openly ready to say, we got a problem. My expenses were underwritten at 40% and now they're 50%. My rent growth was supposed to be 12% and now it's 4%. I still think there's a shortage of apartment housing. There's plenty of demand, and really the supply side of things in some places is aggressive. Otherwise it's not. It's just there are things that people got a little too exuberant and optimistic about. And if what I was taught, the number one rule in doing a real estate deal is protect your downside risk and underwrite for the worst case scenario. And I think if you do that, you're going to be much less inclined to make mistakes. But there's emotion in this business. People get really heavily emotionally involved in these deals, and trying to get in a competitively bid situation. People are crazy. They pull out all sorts of stops to try to get you to pick them as the buyer, and probably make some irrational decisions and cut some corners. And some people will pay for it, and others will probably get away with it a little bit. But
like, what's the craziest thing you've seen someone do in the best and final? Because what's funny, this is why I never buy any properties in these scenarios. I just look at the computer and go, it doesn't make enough money. Next deal.
So this Carolina deal wasn't. I'm not the lead broker on it. I was getting calls from people, trying to take this thing off the deal or off the market from the second that it was put on the market. And we got 46 offers, which I don't remember anything in 2021 that we ever got that much action for.
What would the day one cap rate be on this?
I think it was like a 5.5. It was like a legit 5.5 cap.
And then why are people all over it? Because you can stabilize it was like a 7 or what's the
pure value add deal, huge upside.
Okay.
And so people are offering to I don't know, it's like we'll fly, come pick you up in Chicago in the private jet. We'll fly down there, tour, take you out to dinner. It's just anything that they can do to get in. And as far as the answer to your question, I'd have to think about that. But okay. It's like why people don't like to lose, and I think for a lot of the buyers, it's kind of a sport. To a certain degree, and quite honestly, a lot of these people have been the bridesmaids, meaning they're second or third place on a lot of deals for a long time, because going back to 2021 and 2020, there are a lot of big institutions in the market that just there was no way you were going to compete with them because their cost of capital was so low. So I think there's been a little bit of pent-up frustration from the private capital side of things, where a lot of these guys are like, oh man, like now's our time to actually get some of these deals done because all the institutions are out of the market. So,
and these are, where do they get their equity from? The people that would be,
it's a lot of it's friends and family. And, some of it is, family businesses where they started, it's either the patriarch or an uncle or something started the business, and they, just slowly, look, it's not good for my business at all, but the people that I know that have the most money, that have amassed incredible wealth, don't ever sell their properties. They, they started buying one property. They refied it 3 years later. They buy 2 properties. They refi those a couple years later. They buy, they keep doubling.
Yeah.
And now they're, they own 30,000 units, and, some of the equities, friends and family, but personally they own 10,000 units, and so
because one thing that's interesting,
they feed the beast.
If you just play the math out, people are like, how does this even happen? Let's say you bought a deal for $2 million. You put your down payment down. Let's say you own it for 25 years. In that time period, you pay the loan off and it doubles, let's say. You have $4 million now. Mm-hmm. And that's, if this has been done for generations, and that's assuming you did nothing, there's no cash flow, you never refied and bought a second one. Like, you can make a lot of money slowly in real estate. And so, just curious, because I guess for me, I'm always looking we need to hit a certain return. It gets bid up beyond that, and we're done. Well, and so they're just not, they have, you could say they're less disciplined. You could say they have a lot more flexibility, or it's their own money. But because that's so interesting.
And sorry to interrupt, but like, I also have this personal view that like, there are certain groups out there that can afford to overpay for deals and kind of don't care if they overpay for deals.
What does that even, like, why, I guess, how can they afford to?
Because they are going to own it for a long time.
Okay.
And so, so whatever happens in the next 2 to 3 years, they don't care.
So they can just pay the price it'll be worth in 5 years now.
If they have to
they were going to buy it in 5 years anyways, kind of thing.
Yeah. They want control of the asset. And sometimes let's also be honest, there's a lot of egos in this business. And when I was saying, it's competitive, people don't want to lose. And, it's, pardon my French, but like, it's, and I can't name any names, but it's like, if you're talking to someone and they're asking you who else is in the best and final, and they ask you a direct question, is so-and-so in the best and final, and you have a pregnant pause or you don't want to answer it, they're like, oh, that motherfucker, like, and so it's just, there are rivalries in this business too. And honestly, it's what I like about this is it's fun to get things. You don't ever want to be a broker and walk into, you limp into your best and final or something. Having a robust process and all this, fun interaction and fervor about these deals is really what is hopefully fun for other brokers. And it's kind of like the thrill that, other than the thrill of getting, the deal and the thrill of the hunts, I like the best and finals are exciting usually because you never really know what's going to happen.
That's so interesting because my mentality on like the best and finals and kind of what you're talking about is, so the person like I don't really view, they are awarded the deal and they won, but I don't feel like they're a winner if the price is bad, if you will. Now you are, because at a certain level, if you can close the deal, anybody could just pay the most. So like, what did you win? You just were the person willing to pay the most.
Yeah. I mean, listen, we have such, I was thinking about what you asked me earlier. We've had situations where, you award the deal, the second place guy gets super pissed, calls your client directly and tries to make a deal, and sometimes it actually does make the deal with your client directly, and then we have to go back to the guy you awarded the deal to and be like, oh, by the way, like someone came in and paid $2 million more just because they wanted it. From a metric perspective, like everyone's underwriting, differently. A lot of people underwrite on a cash and, they look at their cash and cash or their IRR. And I just think a lot of it is building wealth for their kids and their families and creating that massive wealth vehicle. And everyone knows that it's a good time to invest in apartments, even if the capital markets are not in a great place. Would I be buying like 50s and 60s apartment buildings right now? Probably not, because they just are pretty old vintage, right? And things break and they get more costly. But in the next 30 years, I don't think there's going to be a major surplus in housing anywhere, and I think this whole housing affordability, crisis that it's not a crisis if you just let people build more housing units.
No,
So
we need to curtail housing. This is these greedy developers making all this money. We need. So yeah, no, that's right. Like rent control, these things, it creates less housing that keeps the prices high.
yeah,
If you had something to incentivize building, I mean, New York City had some sort of tax abatement thing that went forever, or not forever, but the program was in existence for a long time that created a lot of condos and apartments getting built. They don't have that now. Plus, interest rates are high, so they're running into like a buzzsaw of no new supply.
Yeah.
And they could have helped themselves by continuing this program. They didn't. So yeah, no, I hear you. That we could talk all day about that. Where that's
yeah, and actually, the one shout out that I will give is I just toured the row in the West Loop. If you're familiar with that, Related just built this project.
Yeah, I saw it being built. Is done.
It's an
now.
incredible
Okay.
building. They did a great job. But the most fascinating thing about it is Related, I guess, and I wonder if this is the program that you're talking about. I guess in New York, there's an 80-20 program, and it's, to build 80% market rate deals, and then 20% is at 60 to 80% at AMI, which is, area median income, which effectively discounts those rents. At 60% AMI, your rents are a third of effectively what the market generally
Yeah, and
speaking.
folks that rent those have to meet certain
Qualify,
income limitations.
And so just, I guess the example would be if the area median income's $100,000, it would be only qualifying for people that make $60,000 could live in those units for X, price. And so this Related building that just got built, they're 1,200 square foot units, which are pretty big. They're getting $475 a foot on average.
Wow.
And they are trying to roll out more of these because in New York, it's been a wildly successful experiment because they have effectively put, middle income and lower income earners who might work at the, grocery store or the restaurants or drive Uber or whatever, and they no longer have to drive in 45 minutes. They actually can live in the neighborhood that they work in, and it actually makes for a much better and well-diversified market, if you will. So hopefully they can get a couple more of those penciled. The problem is getting it penciled. I mean, if you have $475 rents, it's probably it might even still not be easy to do.
Yeah, because you're not getting $475 a foot on 20% of your units, but they cost the same price to build, the same price to operate as the ones that you're getting. But
the city's giving you subsidies now with tax incentives on a real estate tax basis, and so I think things like that are pretty thoughtful because at least the city's helping the developer build the units, get them on site, and populate an area with. I mean, look, the West Loop Fulton market isn't meant to just be for like super rich people, right? And actually, if it was just a bunch of super rich people, it'd probably be a horrible place. So,
right,
nothing against super rich people, but. So I think it's, we could go on for like days about this. But I think it's an interesting, it's worked really well in New York. It's working in Chicago and, places like LA, who are doing the exact opposite should probably try to, figure it out. Has there been there's no rent control conversations in Arizona, are there?
No, there's not, not in any of the places we're looking. Yeah, it's interesting too. That just reminded me on all that expense conversation we had. I mean, I know everyone just loves to beat up on Phoenix. It's like people were jealous.
I've held back.
No. They're jealous. They missed out when
it's a great market,
and it's volatile with the rents. Like Phoenix and Vegas and Tampa and Atlanta. A lot of it's up and down. Where Chicago and a lot of these places are a lot more stable. So I get it. But what's interesting when we're talking about the expenses, insurance, obviously with how little losses there are, way more stable than these other markets. Property tax assessed values, there's a 5% per year cap, even when there's a sale of the property. So you have so much certainty on the expenses that, I'd personally take that over, like, let's say in Florida, you have, like that's a great market fundamentally, but you have a lot of the same stuff Phoenix and these other places have going for it, but you have the costs are just out of control. The taxes are going up, the insurance, the labor.
Which is also a cycle too, though, right? Like a lot of people don't think of it like this, but we're in a bad insurance cycle. There were a lot of, catastrophic storms and events that caused large losses for a lot of these insurance companies. And so now, the lag period is people are getting hit pretty substantially. But it'll come back down eventually. I don't disagree with you. I mean, I think that I always joke with people, like, that's why I live in Chicago. I mean, there's no, what real natural disaster is there up here?
Tornadoes,
maybe
carjackings. That's what you got to worry about here.
Carjackings, maybe, but no, it's stability of your expenses is probably something a lot of people don't really look at, and stability of your labor. And there's nothing probably more dangerous to a just any kind of real estate deal than miscalculating your expenses, right? Even 5 or 10% can really dramatically affect your deal.
Yeah, I agree. I was taking a sip of water, so I didn't say right away, because they, especially, we see people their deal can go awry from the second they bought it if they underwrite property taxes wrong, or never got an insurance quote and we're just using the prior owner's numbers. Yeah. So I can see that. Like
we haven't talked about, I work in some markets that have some real tax problems, like Michigan, Ohio, Kentucky. And like in Kentucky and Ohio, people do something called a drop and swap, which is an entity transfer. It's interesting to go through one of those deals, because as the broker or on the sell side, you're like, oh, just do the drop and swap. You have nothing to worry about. Your taxes aren't going to move. It effectively shields the property from changing recording of title, and so it doesn't trigger a tax reassessment.
Is the term drop and swap, or it's just an entity sale?
Well, there's two different a drop. So they're the same thing. In a drop and swap, it's a little more complicated. It's like a shell corporation's created a closing, and they literally take like the entity and drop it into like a new entity effectively. Yeah,
because we did a couple 1031s where we were combining properties and did a drop and swap, and now it's combined to one entity now. But
but like people have to take a lead. I had this deal in Cincinnati, where, it was funny because we went to the seller and we're like, hey, your taxes are either going to get reassessed at 100%, or we do a drop and swap and they're not going to move. And the value difference was huge. It was like $20 million. And whenever you go to a seller with a $20 million spread, they're like, what the hell are you doing here? And it's like, look, you're either going to get full credit or no credit for this. And the challenge is, if you take that deal to market with the expectation that you're going to get full credit and you don't get full credit, your taxes can go up $500,000 or more. So.
Yeah, that's a big risk. Like as a buyer, I would just be out on that on those markets. I wouldn't want to take that gamble where I bought something and all of a sudden the assessor caught wind of the sale somehow, and now I lose $20 million.
Yeah,
that doesn't sound so good. Not to mention you're also inheriting all the liabilities of this other company you're buying too. Whatever, if there's a lawsuit or something, the slip and fall like that, now you're picking that up.
Yeah, well, it's the same reason. It's the reason why people like Arizona, right? It's the same reason why people like Indiana. Indiana's the same way. 2% cap. It's pretty easy to calculate your taxes. You go to Michigan, and you need like a Harvard degree to figure out what the taxes are on every deal. And so, it's interesting how different parts of the city or out of the country are so different from a tax and bureaucratic perspective, but it also makes sense why the whole, most astute investors are all flocking towards higher growth red states with less regulation and not more regulation.
Yeah, and then I mean that's where all the jobs and businesses are going. It's a simple business sometimes where you need people to live in your buildings, and so you should go where the people are going.
Yeah,
right. That's what the guys at Dominium told me when they were expanding from Minnesota to the south. Was like, why don't we, we have 20,000 apartments mostly in the Midwest, but that's where people are. Not that many people are moving to the Midwest. They're all moving to Arizona and Texas.
I think that's changing though.
Atlanta and. Yeah, I mean the country's growing. It's interesting. I think I looked it up. 15 states in the last I forgot what the time period was. I think 2021 to 2022 lost population. So it's not growing everywhere. Yeah. But what were you going to say? That was Midwest is growing. Is that
no? It's a little slightly off topic, but we've been hearing a lot of rumblings, especially in some of these Rust Belt, cities, and in Ohio particularly, that like there's a resurgence of manufacturing and tech in this country, and a lot of it is being relocated into the Midwest, into like Kansas City and Columbus are two great burgeoning markets with a lot of tech moving in and tech manufacturing moving in, and it's because the labor is cheap, when compared to the coasts, and the housing's cheap, so people can their employees can live a good life, get a good wage, and not have to pay $1,500 a foot to live in Silicon Valley, where you're like making $1 million a year and you can barely afford to go to the grocery store. I'm obviously being facetious, but like,
pretty close. You go on Zillow and it's like, it feels like an average house in the Bay is like $4 million.
It's crazy.
Yeah.
Where you go to Kansas City, you could probably get a house for $500,000 in Kansas City that's couple thousand square feet and has a yard and probably a good school system. So
yeah, no, that's interesting. Yeah, I can see that, and it's so market by market.
Yeah,
but I still think primarily
the growth is not. You and I'm not trying to argue against the growth in Arizona or Texas or even Florida or the Carolinas, but it's better than it was, and you were going from a place where you had GM plants and manufacturing, going to China and other countries. And we've slowly, because I have to be involved a little bit in like the microeconomy in all these places, it's been slowly coming back. And that's a really good thing for America.
Yeah, it is.
In general.
Yeah, and it's not great for the country if everyone moves to Florida and the South either. Like we need, it's better if people are spread out. It keep the pricing less crazy of things. And it's also just so odd how, from like a weather standpoint, where like, aren't we supposed to be, global warming and eventually we're going to run out of water and we need the Great Lakes and all this, but the states that are booming the most, it's like the top ones. It's like, I think, what is it? Like Utah is number one or something. And then it's it's Florida, it's Texas, it's Arizona, it's Vegas. Like, what about global warming and water and the oceans rising and whatnot? Like, is everyone going to move down there and then in 50 years be like, now we need to move back to Chicago?
I think most people feel like it's a longer term problem that they don't have to deal with and their kids will deal with it or whatnot, which is probably not the right answer. They're going to have to figure out something.
Yeah. But people can also invent solutions. Some, too, like and stuff goes in cycles. Like obviously we're warming up the planet. Anyone who's stood in a parking lot knows paving everything is adding heat, but is it somewhat of a cycle? What is it? But it's just more interesting observation where it's like, I thought the oceans were rising and it's getting hotter and hotter. Why are you going to Miami? Is like the new New York. Like, why is that happening? Shouldn't they move this to Michigan or something where it's not going to flood?
I am not negative on many places. Like I would, personally speaking, I would never invest in a deal in Miami.
Why is that? I'm interested because that is one of the strongest apartment markets and housing markets in the entire country.
I know.
I mean, even Goldman Sachs had a report on predicted housing prices for 2023, and only one market was positive. Miami.
That's actually really interesting.
We have a market outlook model for Breneman Capital, where we've inputted population growth, job data, demographic data by the zip code for the whole country. And the number one market for price appreciation, for the highest appreciation in multifamily, is Miami in our model.
So, I feel like if you go to try to buy something in Miami, especially if Goldman Sachs is telling you it's the greatest market, okay, the demand there is going to be very significant. So you're going to have a lot of competition. You're going to probably pay a very high price. You pay a low cap rate. You have extremely high insurance costs. There are these things called hurricanes that come around every once in a while. And it's sinking into the ocean eventually. I don't know if it's in 10 years or 100 years, but if you're in an environment like that, it's going to have a diminishing return in some way, shape, or form. And so my in-laws live in Wilmington, North Carolina, which is
that's on the coast, right?
Quasi susceptible to hurricanes. And the joke in Wilmington is the only time you buy a beach house in Wilmington is after a hurricane, because your property that beach house is $5 million, and then the hurricane comes and it's $1 million. Right after a natural disaster happens, the market gets decimated, the capital gets scared, and they get the hell out of there. And that is, you're talking about stability of Arizona, and even Dallas. Like, Dallas is a boom bust market. Dallas has defied all odds and logic and grows like a weed and is a great place to invest. Miami's just a little scary.
If you could tell us more about Dallas, if you could.
Yeah.
No, I'm just kidding. But
no. I would tell you this. I think what I admire about Dallas is they've delivered 20 to 30,000 units for God knows how many years in a row. Okay, a lot, and it's grown substantially, but it's really a surprisingly affordable place to live, and it's kind of a great example and proof of what I believe in, that the supply side of housing solves all the affordability problems. Okay, density breeds affordability, and in Dallas, you could go move into a brand new beautiful, and I don't know the market that well. You can go move into a brand new beautiful place, $3 a foot or whatever it is.
No, less than that.
It's not $5 a foot. Okay, like Chicago is the exact opposite of Dallas. Chicago's an artificially inflated real estate market because you have a bunch of aldermen and a bunch of people who think they're really important and can control, important development decisions in the city. And then they open it up to the communities and let, Debbie in her condo, who thinks she's an architect, dictate your height and your density and, whatever. And so in Dallas, they've flooded the market with apartments. You have a ton of product. You have great product. It's all occupied. It's actually pretty affordable. And, like I said, in Chicago, it's extraordinarily expensive to build here. And you have to get these rents. They're who can afford to pay $5,000 a month for an apartment?
Yeah.
That's even if you make $200,000, $300,000, $400,000 a year, that's a lot of money. And so, I think that Dallas kind of is the poster child of, it used to be a boom bust market. It's not really a boom bust market anymore.
No, it's so diversified, and in the best stat that we have in the we looked at the price declines of houses in the GFC, so 2008 to call it 2013, looking at the price action. We broke it down. It was as a percentage, but then we're like, let's make it a simpler explanation. So assume in each market we have the information on. It was from Zillow. Let's say you had $100 house starting at the peak of the market. What's it worth at the bottom? In Florida, in some of these places, Vegas, and in Phoenix, I mean, these houses went into like the $40.
Yeah.
In Austin and in Dallas was about $88. How crazy is that for like a strong housing market? For it has the least volatility of return of like pricing, like almost out of anywhere Texas. That's really one of the things we liked about it, because obviously we like Phoenix, but that is up and down. So then and I like being in the middle of the Sun Belt. Obviously I moved to Austin, but now if we want to also but like buy in Atlanta or Nashville and coming here is 2 hours in a plane, like it's a nice location.
It's a central location,
and I like lakes too.
So
it's
so something you just said made me think of this. So back to Miami very quickly, and we can be done. So I have a good friend who moved to Boca with his family in 2018. He bought, a normal 4-bedroom house. It was like $850,000. He got an appraisal last year after a ton of people tried to buy his house for $4 million.
Wow.
Okay. And it's like people bought houses in 2019 for $500 and sold them for $2 million 2 years later. That to me is like, that has to be unwound probably at some point, right? And so I still stand by my hurricane comment. That's probably my number one reason to not go there. And I probably wouldn't go to Tampa either for the exact same reason, even though there's less risk there. But anywhere where your housing price is quadrupling in a couple years, there's got to be something else going on, right? And that probably isn't sustainable.
I hear you. Yeah, that's been, even though it's our number one market in our model, like you need to think beyond the model, and that's part of the.
You fit better in Texas than Miami.
A lot of some of the, yeah, I know this lady that I met in Austin, who had lived in LA and then moved to Austin, I think was what and had lived in Miami. This is where this makes sense. And I was like, what was Miami like? Because I mean, actually one of the things I like about Austin is all the lakes that are there. I grew up in a part of Wisconsin where there was a million lakes, and so I'm used to that. And it's like my only hobby, basically, let's say at this point. But so Miami sounds cool. If you need a lot of money there, to do anything fun,
you need a lot of flash.
Because I was joking with someone, like, if you have $10 million to spend in Miami, no problem. $4 million house, $5 million house, and a $5 million boat.
Yeah.
In Dallas, it's like you have $10 million to spend. It's like $3 million house, and then what?
Yeah.
It was when we were in Dallas, we were talking about like the costs and stuff.
Go get a ranch somewhere.
Yeah. And anyways, then now we're just talking about nonsense. But anyways, what she said was living in Miami was like LA and Vegas had a baby.
Yeah.
And I don't know.
It's a flashy.
Yeah.
It's not for everybody also, right? It's a flashy place.
But I guess then let's, to close it out, what markets are you seeing that come to mind when you say like are having trouble? Then, okay, Florida is with insurance and costs. I'd say like because I think you're talking about some that were faring well, some that weren't.
Every single place along the Gulf Coast, if it's small market, big market, that insurance problem is pretty widespread. It's
so from Naples to Houston.
Yeah.
Problems.
Pretty much.
Okay.
Carolinas are red hot. It's pretty easy to pick on, New York, I guess. But, the interesting thing, and I'm doing the opposite of what you asked me, but like I would have said LA if I didn't talk to my counterpart in LA a week ago. And the LA market is apparently picking up in a meaningful way, despite a lot of negative things going on.
Well, a lot of the gateway markets. So you're, with the exception of ones where like San Francisco, so New York and LA, from like 2000 to, or let's say from the whole time I looked at information from like say the 90s to 2008, it was always like you look at those reports like what are the best markets, and it was always just the number one apartment markets were New York, San Francisco, LA only. They did the best. They had the lowest cap rates, the highest rent growth, the least vacancy. People still have that in their heads, but the fundamentals about in 2012, it changed. The best markets are all in the Sun Belt now. There's times where like Indianapolis, Chicago, they're doing well right now. That's great. It's making up for lost time. But rents barely increased in those places from 2015 to 2022. So that's great where you're getting rent growth now. But so what's weird though is the buyers in those markets, they're detached from the fundamentals. Like they're used to buying a 4 cap rent control building in New York or LA and not being able to raise their rents and having their NOI go down. And they think that's real estate investing. You put down 70% and you make no cash flow, and
they're going for the depreciation.
I mean, that doesn't make any sense. You should buy a gas station and write the whole thing off in 1 year then.
So unfortunately for you, the worst market in the country is Minneapolis.
Why is that unfortunate for me?
I don't know, because you own some product up there.
Yeah, it's all commercial actually there. I don't own any multifamily.
No, it's actually a really sad state of affairs because it's a great city and it's a great just state in general. But they've been overtaken by leftist liberal bureaucrats who are rolling out crazy policies that are having detrimental effects on their city, on their county, on their state. The capital is leaving. The corporations aren't, really trying to stick around, and it's just kind of in a market that in 2017 was Austin, Texas, or almost as hot as that.
Yeah, it was the number one market.
It was an incredible place.
Brokerage reports.
It's unfortunate, the George Floyd thing, and then some resulting, bureaucratic changes has made it kind of the pariah. I would say.
I mean, they had so much building. I remember going there in like 2019, and so many apartments were under construction. I mean, I've never seen it like that in America. I mean, I literally told Jim, my partner on those from Minnesota, this looks like parts of China right now. This is like so much building. I've never seen something like this. But that's because it was number one market, 2017. So money starts flowing there. Anyways, any place you defund the police and then start rent control, that's not great for investments.
No. Well, it's scary. What is capital ultimately? Where are the best markets in the country? Places that are stable with without a lot of drama. People want to, if they're going to take their millions of dollars and invest it somewhere, they want to know it's safe and that it's going to be taken care of, and that they are not going to be treated like criminals for investing in the market, or don't get me started on the whole law and order aspect of like our society right now. But, that's one of the biggest disservices. Like Chicago, for instance, if this city just cleaned up all the crime, I think a lot of the capital would actually start to come back because it's
the only problem would be the property tax uncertainty.
Yeah.
And then
which is kind of over though, a little bit. I mean,
owning, 20 or so properties here, it's not, you still have, you went through this first reassessment wave, where now all the buildings got raised, but so many of them got reduced at the board of review. We're in like the second inning of this tax nonsense, in my opinion. And like you got some buildings that are underassessed, some that are way over. And
by the way, he's forcing sales too. I'm selling a building right now that is getting sold for effectively what it cost to build it, because Hague came in there, and the taxes 2.5x, and talk about a huge hit to your NOI. I mean, they lost millions of dollars of value because he got a little aggressive on the north side of Chicago.
Well, that's why I'm saying it's more than crime. They need to get tax certainty, even if it was the rates are higher or you're paying more. Like in Chicago, probably the most common, let's say, percent of your income that you're paying in taxes, property taxes, is probably, depends on the deal, 15 to 18, 19%.
It's like that in Ohio too.
Obviously, you can get screwed and be way higher, but in like other states, in Texas, in Minnesota, in a lot of these places, it's higher. But they know how it works. Mm-hmm. They chase your sale there, and you just assume it went to your sale price, or 95%.
Making it predictable is a huge thing.
So even though the rates are just as bad and the amounts you're paying are high, it's like they actually provide certainty though, and but the crime, that's caused a lot of people to be uncomfortable. Or
I mean, and some of that, we talked about the capital markets problem. Look, sometimes people have bad timing, and if you bought something in 2019 in Minneapolis, you probably felt pretty good about it, and then a year later there was a black swan event that killed the market, and that market's not going to recover, I don't think, for 10 years probably.
I mean, they need to have a reason to move into the city, and right now they have just as bad of a crime perception as Chicago. Mm-hmm. The crime is nowhere near as bad, though. It's interesting to hear about how mild it is compared to Chicago, but it's the same perception. And then it's a lot easier to get to the suburbs there. It's like they don't have the traffic we have here.
But by the way, the suburbs in Minneapolis are actually thriving.
That's what I was
doing
saying.
Really well.
It's
the city.
That's where I was going. The suburbs are strong, and it's as simple as that. Yeah. People don't feel safe in Minneapolis and St. Paul. They move out. It's a 5-10 minute car ride down to nice suburbs. Take your pick, Golden Valley, Minnetonka. There's a lot of places really nice close by. Chicago is a bit different. It's going to take you an hour to get to the nice suburbs nearly.
Do you know what the difference too is? And I just thought of this, New York City had a very, and still does, significant crime issue when de Blasio was in office, and it's carried into I'm forgetting the new mayor's name, Eric.
I'm not going to know. So
but anyways, people want to live in New York though, and people are willing in New York and Chicago to be like, I don't care. I want to go have some bougie eats and have the culture and the amenities that this city and New York have to offer. And if you're in Minneapolis, there's parts of Minneapolis that are great, like the North Loop, but it's not, it's not enough to create a sticky reason for people. And right. LA is the same way. I think the one city actually that is going to probably be a casualty too, for the same exact reason, which is the most obvious one, is San Francisco. I mean, talk about a disaster. Completely. I mean, who would have thought that having drug addicts on the street, harassing people would be a bad thing, right? And that would drive businesses away and drive people away from wanting to live there. A lot of it's just logical. And, at some point, some of the people in our society have decided to go in a different direction. And it's kind of sad to watch. San Francisco's a great place. Beautiful city, lots of culture, lots of amenities, and they're having a crisis of their own right now.
Yeah, no, I hear you. I agree. And we'll wrap it up with one positive comment on Chicago. So, some of the smaller deals, those are holding up a lot better pricing wise than the institutional stuff you're talking about. So any of the brokers that we all know that are doing those $2 to $10 million deals would be saying right now it's not as bad as Tyler's saying. So when you're on the private buyer side, it's stronger, and rents are at all-time high. Yeah. So it's not all negative, but.
By the way, I actually believe in Chicago. Like I said, I have a number of deals here right now, and I am not trying to be overly negative. I'm just trying to be real about it. And at the end of the day, the funniest thing about all of this is the Chicago market right now is more liquid than it's ever been in the last 5 years. There have been no trades here for, we're in the hottest real estate market, since Jesus. And no deals traded in Chicago, which is weird. And then all of a sudden you have a capital markets problem. There's some desperation out there, and you're seeing some trades that are, good for the market because there's liquidity and there's investment coming here. But if I was a Class A luxury developer, merchant builder trying to deliver some product in the city right now, I'd be a little scared because like Emmy that just traded for $365 a door. That deal should be worth like $450 a door, in my opinion.
Yeah, and there's no
in 2016, that deal trades for probably 4.5 cap, $450 a door.
Well, the NOI per unit might have been higher.
Yeah, but so I think personally speaking, there's a couple big buyers out there that are taking the contrarian view in Chicago, and including the one that bought the Seneca. That's a good client of ours, and I think they're going to make out like bandits. And in 2 or 3, just like in 2007, you saw some trades in this market back then that were a little eye-popping. And the people that had the stomach to jump in and do it, maybe it was all cash, maybe it was they had to put 60% equity in. But they, a year or 2 or 3 later, doubled their money and did really, really well. And I actually think that's exactly what's going to happen here. And then once that starts to happen, I think this market will start getting going again because people are going to feel like they were missing out. So
all right.
I'm actually more bullish on Chicago than I probably put out here. But it's just the hard thing for me is there's uncertainty about whether or not things are going to improve from a crime and a tax and some of those other fronts, and a little bit of movement in that would go a really long way.
It would. So let's leave it there.
Yeah.
So how do people get in touch with you? They want to reach out.
Email tyler.hague@colliers.com, and I'm available on my phone. You can call me at midnight if you want to.
All right, and just look up his phone number.
Yeah.
And shoot him a call in the middle of the night. Sounds good. All right, cool. Thanks for being on. Appreciate it.
Yeah, thanks for having me again.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.